Hello and welcome. If you're a trustee or a beneficiary of a UK family trust, there is a 10-year deadline that you absolutely positively cannot afford to ignore. Today, we're going to be talking all about the 10-year inheritance tax charge and a crucial bit of paperwork that goes with it, Form IHT100D. So, let me ask you, is your trust getting close to that decade milestone? Because if it is, you'll really want to pay close attention. An awful lot of trustees get caught completely off guard by this, and, well, it can lead to a pretty significant and often completely unexpected tax bill if you aren't ready for it. And just so you know, all the information we're covering today has been put together by the expert tax advisors at My Tax Accountant. They're one of the UK's most trusted accounting firms, known for giving really clear, straightforward advice on this kind of complex stuff. We've laid out a pretty clear roadmap for our chat. First, we'll talk about the 10-year tax surprise itself. Then, we'll get into exactly what Form IHT100D is. After that, we'll walk through the key bits you need to report, highlight some common mistakes people make, cover how to get it right, and finally, finish up with your next steps. Right, let's get into it. Okay, Section 1, this 10-year tax surprise. You know, for most trusts, a 10th anniversary isn't really a time for cake and celebration. It's actually a critical financial deadline that, honestly, many people just don't even have on their radar. You know, probably the best way to think about it is like your car's MOT. It's this mandatory, regular checkup with the authorities. It is not optional, and if things aren't quite in order, you could easily find yourself facing a rather nasty bill. So, the official name for this is the principal charge. It's a form of inheritance tax, and it applies to trusts that hold something called relevant property. Now, in plain English, that usually means discretionary trusts. You know, the type where trustees have the flexibility to decide who benefits and when. Essentially, HMRC wants to check in every 10 years, take a look at what the trust is worth, and see if any tax is due. Let's make this really simple with an example. Imagine the Patels, a family in Manchester, setting up a trust for their children. Over the next 9 years, the assets in that trust, maybe a property, maybe some investments, they grow in value. Then, bang, on the morning of the 10th anniversary, a tax event is automatically triggered. The trust has to be valued, and a tax charge might be payable. So, how on earth do you report all of this to HMRC? Well, that brings us neatly to Section 2 and the specific piece of paperwork you need, which is called Form IHT100D. This form is designed for one job, and one job only, and that's to give HMRC a complete snapshot of the trust's assets right on its 10th anniversary, and then to calculate that principal charge we just talked about. It really is the central piece of the puzzle for this entire event. And this just lays out the process perfectly. The anniversary date arrives, and that's the trigger. It means you have to get a full valuation of everything the trust owns. From those valuations, the tax is calculated. And finally, you package all of that information up and file it with HMRC using Form IHT100D. Right, so what does this form actually ask for? We're not going to get bogged down in every single box here, but let's focus on the key information that you absolutely have to get right. Okay, the single most important point is this. You must report the open market value of every single asset. That means what it would actually sell for on the open market on that specific anniversary date. And this catches so many people out. You can't just use the value from when it was put in the trust or an old estimate from a few years back. It has to be current. And, you know, it's almost never as simple as just filling in one form. The amount of paperwork can really expand depending on what the trust actually owns. So, for example, if the trust holds stocks and shares, you'll need a supplementary form for that. If it owns a building, there is a different form for land. If you're trying to claim specific reliefs, like for a family business, well, that requires another form entirely. It can all add up to a pretty substantial pile of paperwork. Now, you are definitely going to want to hear this next part. Filing these forms has actually become a bit trickier recently because of some changes over at HMRC. This section is all about the common pitfalls and errors that trustees are running into right now.
So, what's changed? Well, it used to be that you had a main form, the IHT 100, and you'd attach other forms to it. To try and simplify things, HMRC got rid of that main form after 2024. So now you just use the single specific form for the event, like our IHT 100D. In theory, that sounds much, much better, but the rollout hasn't been perfectly smooth.
And this is where it gets really interesting, because these are not just minor glitches. Tax professionals are reporting some pretty significant teething problems with these new digital forms. For instance, the form's own automatic calculations for certain tax reliefs have been found to be just, well, wrong. There are also bizarre issues like American date formats causing mix-ups and fields that won't even let you enter pence. It's a massive warning sign that you just cannot trust the form to do the maths for you.
So, given all of those potential traps, let's really focus on the absolute non-negotiables, the numbers and the deadlines you simply cannot afford to miss if you want to stay compliant.
Okay, this is the big one, the deadline. You have 6 months. And be really careful with this one. It's not 6 months from the anniversary date itself. It is 6 months from the end of the month in which the anniversary falls. This is a hard deadline for both filing the form and paying any tax. If you miss it, HMRC will start charging interest and penalties straight away. And what about the tax rate? Well, the maximum rate for this charge is 6%. Now, that's applied to the value of the trust's assets that's over the available tax-free allowance. For a trust holding some serious assets, a 6% charge can very easily turn into a tax bill of tens of thousands of pounds. And here is a vital tip from me to you. Do not guess the value of the assets. You need to get proper, professional, formal valuations for everything. Property, shares, artwork, the whole shebang. And they must be dated as close to that anniversary date as possible. Just sending in old figures or your own best guess is a huge red flag for HMRC, and it can lead to some really serious problems down the line. Okay, so we've covered what the charge is, the form you need to use, and the pitfalls to look out for. Let's wrap things up with a clear guide on your next steps to make sure you're fully prepared and compliant. Right, before we finish, just a very quick disclaimer. The information we've gone through today is for general guidance only. It is absolutely not a substitute for professional financial advice, especially since tax laws are complicated and they do change. Honestly, given all the complexities we've discussed, the potential for errors in those new forms, and the serious financial consequences of getting it wrong, the safest, most sensible path forward is to get some expert help. You can get in touch with the specialist team at My Tax Accountant for advice that's tailored specifically to your trust. And that really brings us to our final thought. If that 10-year date is looming on your calendar, ask yourself, are you truly confident you have everything in place to handle it correctly? Please don't leave it to chance. Thank you so much for joining us today. And for more practical, clear updates just like this one, please do subscribe to the My Tax Accountant YouTube channel.